Everyone asks the same question. They want the ticker symbols. They want the buy list.
They want the secret map to the next Nvidia or the next Apple. It is a natural impulse. But after analyzing 7 decades of financial history, Capivestor has uncovered a stark truth
That most retail investors ignore at their peril. Building wealth is not just about what you buy.
It is about what you survive. You can spend a decade making brilliant decisions, compounding your capital at reputable rates. But a single catastrophic error, one miscalculation in a sector facing structural collapse,
can incinerate years of progress in a single fiscal quarter.
The golden rule of investing is not get rich. It is protect the capital.
Today, we are going to conduct a forensic analysis of the market landscape for 2026.
We are not here to sell you a dream. We are here to issue a warning. We are identifying the 5 sectors that smart money is quietly abandoning. And more importantly,
We are going to dissect the mathematical and structural reasons why.
this is about adopting a cold, hard, realistic perspective.
It is about recognizing when the casino has rigged the table against you.
But before we expose the specific industries in the crosshairs, we must understand the mechanics of the value trap.
Consider the historical case study of the New England textile industry in the mid-20th century.
This was not a sudden crash. It was a slow, agonizing suffocation. A legendary conglomerate once poured millions into revitalizing textile mills, driven by the belief that better.
They slashed overhead. They fought tooth and nail. But they were fighting a war they could not win.
The industry faced insurmountable headwinds, cheap overseas labor, and a fundamental shift in global manufacturing economics. The lesson that cost investors millions back then is the same lesson that will save your portfolio today. When you fight against a secular trend,
A long-term, irreversible shift in the way the world works. Capital is not just lost, it is vaporized.
understanding this difference between a temporary slump and a permanent death spiral is the key to surviving 2026. Let's begin the investigation with sector number 1, commercial real estate, specifically the office sector.
The data is alarming. We are seeing a permanent transition to hybrid models.
If a corporation realizes it can maintain productivity with employees coming in only 2 days a week, their demand for square footage collapses.
This is not a cyclical recession where demand will roar back when GDP grows. This is a utilization crisis.
The landlord and tenant negotiation resulted in a rapid decrease, shrinking the required footprint from 50% down to 30%. The financial consequences of this are terrifying when you look at the debt structures.
Office towers are not bought with cash. They are bought with massive leverage, loans often covering 60% to 8% of the building's value. These loans rely on steady rental income to service the debt. When vacancy rates spike and rental income plummets, the math breaks. We are seeing Class A buildings in major metropolises trading for half of what they were worth just 5 years ago. But here is the open loop that should keep you awake at night. There is a hidden contagion risk here that goes beyond just landlords.
But let's look at the granularity of construction physics. Office buildings have deep floor plates. The distance from the window to the elevator core is massive.
Residential code requires bedrooms to have windows.
To convert a modern office tower into apartments requires coring out the center of the building, completely redoing industrial-grade plumbing.
The cost per square foot for conversion often exceeds the cost of building a new tower from scratch. This is why so many of these buildings will not be converted. They will simply rust. This brings us to sector number 2, traditional retail, specifically the department store and the shopping mall.
This is a sector that has been bleeding for a decade, and the wound is only deepening.
The mechanism of destruction here is the optimization of logistics. E-commerce giants like Amazon have department stores, once the anchor tenants that drove traffic to malls, are operating on a broken business model. They are burdened by massive inventory holding costs, prime real estate rents, and heavy labor requirements.
They cannot compete on price because their overhead is too high. They cannot compete on convenience because they require a physical trip.
We have watched iconic American brands file for Chapter 11 bankruptcy, liquidating assets for pennies on the dollar.
When we visualize the data, it becomes clear that the minimalist approach significantly improves user engagement metrics across all platforms.
The consequence for the mall ecosystem is a domino effect. When an anchor tenant like a Macy's or a Sears goes dark, foot traffic to the entire mall collapses. This triggers co-tenancy clauses in the leases of the smaller stores, allowing them to break their leases or pay reduced rent. The mall owner's revenue evaporates, but their debt payments to the bank remain fixed. It is a mathematical death spiral. While grocery-anchored centers and home improvement stores, businesses where you need to touch the product, show resilience. These are businesses where you need to touch the product. The traditional indoor apparel mall is facing an existential winter. Why would you deploy your hard-earned capital into a business model that the internet made obsolete 15 years ago?
Now, let's pivot to a sector that was once a license to print money. Sector number 3, legacy media and linear entertainment.
For 40 years, the cable bundle was the greatest business model in history. You paid for 500 channels, watched.
That monopoly is gone. We are witnessing the chaotic disintegration of linear television.
The younger demographic has not just cut the cord, they never plugged it in. They live in a customized, on-demand ecosystem of YouTube.
The legacy giants, the networks and cable conglomerates, are trying to pivot to streaming, but the economics are brutal.
In the cable world, customer acquisition costs were low and churn was non-existent. In the streaming wars, customers can cancel with a single click.
Companies are spending billions on content production to fight a war of attrition against tech giants like Apple and Amazon, who have infinitely deeper pockets.
Furthermore, the one pillar holding the cable bundle together, live sports, is cracking.
As sports leagues begin selling streaming rights directly to tech platforms, the value proposition of a $100 cable bill evaporates.
This is a sensitive and complex topic, but Capivestor demands objective analysis. The Chinese economy is vast, and its engineers are brilliant. But for a Western investor, the risk profile has shifted from growth to geopolitical gamble. The core issue is the unpredictability of the regulatory environment. In the West, while regulations change,
In China, we have seen entire industries, like for-profit education and video.
From a structural standpoint, many of these investments are held through variable interest entities, or VIEs, designed to bypass Chinese restrictions on foreign ownership. You do not actually own the underlying Chinese company. You own a contract that mimics ownership.
If the geopolitical winds shift, the enforceability of those contracts is an unknown variable.
When you cannot trust the continuity of the rules, you cannot calculate the discount rate for your cash flow models.
And if you cannot calculate the value, you are not investing, you are gambling.
Finally, we arrive at sector number 5. Speculative, profitless technology.
This includes the story stocks, companies with minimal revenue, massive cash burn, and valuations hinged entirely on a utopian future.
During the era of zero interest rate policy, money was free. Investors were willing to wait 20 years for a profit.
But we have entered a new epoch of normalized interest rates.
Here is the math that destroys these portfolios. The value of a company is the present value of its future cash flows.
When interest rates rise, the discount rate rises. We are seeing a ruthless culling of companies that have great ideas, but bad unit economics. Whether it is unproven cryptocurrency platforms, flying taxi startups, or niche AI wrappers, if the business can— And in 2026, the capital markets are becoming discerning. We are likely to see a wave of insolvencies where equity holders are wiped out completely.
But why is it so hard for investors to let go of these losers? The answer lies in a psychological flaw deeply imbued in the human brain.
One that we must surgically remove if we are to succeed.
It is called loss aversion. It is the pain of admitting a mistake.
Investors will hold on to a plummeting office right or a crashing speculative tech stock because selling feels like admitting defeat.
They tell themselves, I will just wait until it gets back to even.
Let's run the numbers on that dangerous sentiment. If you take a 50% loss on an asset, you need a 100% gain just to break even.
A 100% gain is a monumental task in the financial markets.
By holding on to a structural loser, you are not just losing money, you are losing time.
You are trapping capital in a zombie asset when it could be deployed into high-quality, compounding machines.
Energy, industrials, established tech titans that have the wind at their backs.
Smart money does not fight the tide. Smart money reads the current.
The common thread across office real estate, traditional retail, legacy media, regulatorist tech, and speculative junk is this: the odds are stacked against the house.
These are industries fighting gravity. Management teams in these sectors are not building, they are managing decline.
In 2026, you do not need to be a hero. You do not need to swing at every pitch. In the game of capital allocation, there are no called strikes.
You can stand at the plate, bat on your shoulder, and watch the nasty curveballs, the dying malls, the empty offices, the hype coins whiz by into the catcher's mitt.
You wait for the fat pitch. You wait for the high-quality business trading at a fair price. This is how dynasties are built. Not by chasing the impossible, but by avoiding the inevitable disasters.
The landscape of 2026 is treacherous, but it is also filled with opportunity for those who can see clearly.
If you are ready to stop gambling and start operating like a financial institution, if you are ready